Welcome back to our intermediate financial accounting class and to our special lecture on time value of money. Now, in our previous segments, we've talked all about interest. We've talked about the different elements that go into time value, lump sum, annuity, present value, future value. We've done some basic examples. And then in our last couple of segments, we've talked about business decisions specifically and looked at bond values as our example of business decisions and how to use time value to make business decisions. And as we left that last segment, I gave you an assignment, and that was to finish up the Bond 3 calculation and see if it came out the way it was supposed to come out. So let's take a look at those numbers first so you can see how you did. This was a semi-annual bond, so we had to divide our interest payment by 2, we had to multiply our N by 2, and then we had to divide our effective rate or market rate by 2. And once we'd done that, then we were able to do the rest of our calculation. We came up with a total of $728,823, which is indeed a premium on this bond, which is what we wanted. Now the question with this bond, as with every other, is should we buy it or not? And the answer is, well, if it's less than this $728,000, then you should. If it's more than the $728,000, then you shouldn't. It's not a good deal. Anything I get it for less than that 728 just gives me extra interest. Right now, if I were to buy it for the 728, I would get exactly 10% interest on this bond. That's how it would work out over the life as the interest payments came in compared to how much extra I had to pay at the beginning. That's what this calculation gives to us. How much are we really going to get? You'll often see bonds like this referred to as being sold to yield 10% or 8% or 12%. And that sold to yield percentage, that's the amount you're actually going to earn over the life of the bond if you were to buy it at the price they advertise. If you can get it for less, you'll make more than that effective rate or market rate. If you buy it for exactly that much, you'll get the market rate. If you buy it for more, then you blew it. You won't even get your market rate. So that's what all of this does. And from a business decision standpoint, it's all about, should I make the investment or not? From an accounting perspective, we assume you bought it for the 620 or the 728. Now let's do the journal entry so that we can show the money going out and then the interest coming in, and we get it back to what we're actually going to receive at the end of the payments, which is that $550,000 lump sum. On the flip side, as a company that is issuing this debt, we would say I would issue this for at least the 728. That would give me enough cash to make it worth my while to be paying these extra amounts. So we can go either way with this. Do I buy it myself, or am I the company that does the investment? Either way, I use this number as my guide stick to decide whether or not I should do it. Now, there's lots of other examples of business applications that we could do. I just want to look at one more, and that is what happens if instead of a nice, even series of time flows like this one, you end up with an uneven set of cash flows. So annuities, they allow really easy calculations. But a lot of projects, they don't provide annuities. A bond does, a mortgage does, things with banks normally do. But if you're talking about an investment, I'm going to open up this new store. I have no idea if they're going to make they're not going to make a set amount every period. It's going to change. And as soon as they start to change, I can't use the annuity. What I have to do instead, when cash flows are uneven, is I have to treat each payment coming in as a separate lump sum. And then I add up all those lump sums, and that gives me the value of my asset. So let's take a look at an example of this that I think will help. Assume we've got an opportunity to invest in one of two projects. Both offer to give us back $1 million in return for $750,000 today. If we have a 10% interest rate or discount rate, we want to know, should we make this investment for $750,000? So let's take a look at project 1. This one is a normal annuity, $200,000 a year for 5 years. So I can set this up. Present value of this annuity is going to equal $200,000 a year. That's my payment. 5 years at 10%. Let's go get this value. So 10% and 5, 3.79079. And if I multiply that out, I get 758 $750,158. So is this one a good deal? It is. If I can pay $750,000 and get this investment that I think is worth $758, I should do it. That's a good deal. I'm going to make more than my normal 10%. But I have a second option that I'm thinking about investing in, and here it is. Project 2 would give us $300,000 in the first year, and then $100,000 in the second, and $200,000 in the third, and this uneven set of cash flows. So now I can't do a nice annuity calculation. I have to break it down. And I'm going to get a little table put together here so that I can do this. So let's see, we've got years 1, 2, 3, 4, and 5. In year 1 we'll get 300,000. Year 2, 100,000. Year 3, 200,000. Year 4, 250,000, and in year 5, 150,000. Now that we've got these values in here, let's go to our table and get our present value amounts. So we're in our present value of $1 or a lump sum, 10% interest, and now we're going to just tick down because we've got a payment in year 1, year 2, year 3, year 4, year 5. So we're just going to bring these values into our table for our calculation. So let me put these in here. 0.90909, 0.82645, 0.75131, 0.68301, and 0.62092. And if we multiply all of these across, we get 272,727, 82,645, 150, 262, 170, 775, and finally 93, 138. And if I add those all up, 769, 547. So I would compare this again with what I'm being asked to invest, and this is another great decision. If I can pay $750 for something I think is worth this $769, $547, I'm actually going to make more than I thought I was going to make. Instead of making my 10% interest, which is what this would give me, I'm going to make 12, 13, 14, 15, who knows, percent by making this investment at $750. So again, another good deal. The interesting thing about this is we tend to think, oh, I'd love a series of equal payments. It's going to really benefit me. But if you look at these two values, I make almost $770,000 here, and it's only $758 there. So both of them are good investments, but if I have to choose between the two, this is a much better investment with these uneven cash flows. Now we've talked about a lot of stuff with time value, conceptually, mathematically, why we do it, how we do it, and hopefully you're starting to feel really comfortable with these methods. To kind of round out our discussion though, we need to do some practical personal examples, and that's where we're headed in our next section. I'll see you then.